G'day, welcome to the Australian Property Podcast. I'm Pete Wargent from Alan Wargent Property Buyers, and I'm honoured today to be with the big boss man, Owen Rask of Rask Media.
Pete.
It's been a little while between drinks, so good to catch up.
Good to catch up. I don't know about big boss man, but I'll take it, mate. I appreciate you having me on.
Oh, yes. Well, basically, Chris is travelling around Europe this week, as you do. So Owen kindly agreed to step in. So, Owen, I'm coming to Melbourne in a couple of weeks. How's the vibe down there? How's business? I keep hearing conflicting news about the health of the economy in Melbourne. I guess a lot of vacant office space from what I've heard. And I guess talk about mandating working from home, although that hasn't transpired yet. But what's happening in the world with Rask and down in Melbourne?
Well, yeah, I think that's a bit of a joke, isn't it? The old mandating work from home. But Victoria's had some crazy ideas over the years. I think that it depends on which day you come through the CBD, to be honest. Like if you come through today here in the CBD, it's a Thursday we're recording, and it seemed dead this morning. But yesterday, just absolutely pumping. And I think if we're going to talk a little bit about this, about office vacancies and that type of thing. We're looking for new office space. So maybe this is one of the barometers of the market, but we're looking for new office space and there's absolutely no shortage. We're obviously not looking in A-grade commercial property, right? But probably B-grade. And there's so much capacity down here. Just anecdotally, I would say that the asking rents haven't moved that much. The incentives are still there, but I think that there's still a gap between what most tenants, I would assume, are willing to pay and what the landlords want, which is always the case, but I'd say it's still pretty weak. So that's kind of a bit of a pulse check. As for things, I know you're coming down for the AFL, Melbourne's a sporting and food capital, right? And so all of those things are absolutely pumping. More people at sport, more people at going out on weekends. Yeah, that's great. That whole vibe is wonderful and bit happening in property, but from a social perspective, just depends which day you come through to CBD.
Yeah, actually, I did notice last time I was in Melbourne that, during the day, on some days, it maybe not so busy in the CBD, but in the evenings, absolutely packed. It's almost, with people working from home, hybrid model. But actually, from a social perspective in the evenings, I don't think I've ever seen it busier down there. I was just looking at the Property Council stats. Office vacancy rates are near a 30-year high in Australia in July. Melbourne's vacancy rate in the CBD, 18%. So basically almost 1/5 empty. I think on the office space theme, one of the things we've seen in recent years is that the absolute A-grade office space is leasing really easily, but then there's the supply has come online and there's less demand because of working from home. And it's that sort of BC D-grade stock that it really has struggled. And I think what people were hoping to see was more office space being converted into apartments, but for various reasons it just hasn't happened. I think when we've seen cases of that in Sydney, I mean, basically developers have had to more or less gut the entire building, and you may as well almost be building from scratch in those instances. It just doesn't seem to be quite so straightforward. So, that's all good to hear, and I'm only a couple of weeks away from a visit anyway. So what's been news this week? So obviously all the headlines were stolen by the August interest rate decision by the Reserve Bank. I think pretty much as expected, really got 25 basis points cut. The banks are passing it on. Market pricing didn't really change. So we're looking for maybe 2 further cuts this year and maybe 3 in total for the cycle. So it's not it's a fairly shallow easing cycle that's projected. But that would take the variable mortgage rate down to sort of around 5%. So I guess that'll be relatively sort of upbeat for the housing market. I must admit, I actually tuned out of the RBA press conference. I listened to the first bit and then some of the questions were just really off the wall. And I was like, I just went off and did something else. But anyway, looking at market pricing, obviously nothing too unexpected came out of that. So Yeah, I suppose in stock market land, you're seeing some fairly upbeat sentiments at the moment in anticipation of more easing.
Yeah, absolutely, mate. We're seeing it's like in property. There's a very similar theme that plays out in the stock market, which is that quality assets, quality companies, defined as companies that have consistent profits, good dividends, growing, that sort of a thing. Those companies are, you look at the valuations of those, they're stretched. They're at all-time highs in terms of their valuations. Like CBA, super high quality bank, down 5% yesterday actually on its results. Like results were, it's a big bank. They're pretty crap results if you just look at the percentages, but it's a hugely profitable business, super high quality. Valuation had been stretched so much that if you bought that stock yesterday, you would be in effect getting a dividend of about 2.6%, which when you think about the risk of owning an individual stock like that, that's because the valuation had stretched so much. And a lot of that is because of the narrative around economic recoveries, interest rates coming down, people look to move their assets around. So we're seeing all of that, Pete. And I would just say that the where investors need to be careful when interest rates get cut is expectations go up because rates come down, like you get more aggressive in your outlook. But one of the things that people need to be careful of is just not overpaying for less quality than you expect. So a lot of people don't know how to judge quality of investments in the share market, and index funds and all that are great. So if you don't want to do that, that's great. You don't want to pick individual stocks, just use index funds. But I think for the most part, you just need to be careful with that. That's probably the trap right now. I actually wanted to ask you a question though, Pete, because you've asked me how my week is going. I want to ask you two questions. One, how's it over there in the UK? And two, did I hear it correctly last week when you said you're looking to buy in Melbourne?
Look, I might be. Yes. It's funny you mentioned CBA. I can't remember if I mentioned this on a podcast previously, but this is absolutely true story. We found an old stock brokerage account. It might have been E-Trade or something, and it went across to ANZ. It was something like that. We just randomly found that we had some CBA shares from years and years ago. And anyway, I said to my wife Heather, we should probably sell these when the stock price hit a record high. And it was, I don't know exactly, but let's say it was like $110 or something. And I left an enormous amount on the table by selling too early. So the interesting results actually, yeah. So it looks like mortgage arrears in CBA's figures were coming down. The other thing I picked up there, the average mortgage size has gone up basically 10% over the past year. But I think that's largely a function of lower income earners just being locked out of the market. We've got the lending assessment buffer in place. So it's happy days if you're earning 200K plus, but not so much at the lower end of the spectrum. So yeah, look, I've got some, actually just sold a property in my self-managed super over the past 12 months. So yeah, I do have some funds sitting there, and people keep telling me that Melbourne's the place to be. So yeah, I've just got to go through the mortgage application process. So watch this space. I'll definitely keep you posted with what happens there on the podcast. And yeah, the UK, it's been extremely hot and extremely dry. So my back garden over in the UK is like a dust bowl at the moment. So definitely could use some rain. Going down to the Cotswolds next week. So I'm not sure if you're familiar with Clarkson's farm.
Yeah, you're going to go see Jeremy?
Well, I don't know. I've been to Diddley Squat before, and there's a new pub, of course, open down there now.
Is there? You're lifting the lid on the new season. I didn't know that. You mean the farmer's dog or
farmer's
something?
Dog, yeah. So that's up and running now. But of course, it's in a boiling hot sunshine that the UK is currently experiencing. I'm sure it will be rammed. So
yeah.
Anyway, I'm going down there for a festival, which is basically next door at Alex James's farm there, which is an annual event, and then back to Australia after that. So UK. What's happening here? Just enormous budget deficits, fiscal black hole. Everything that moves is being talked about for tax increases. So inheritance tax, national insurance, capital gains. Yeah, basically anything that could be taxed is on the table for being taxed at the moment. So yeah, it's a bit of a downbeat vibe in that sense in the UK at the moment. Unemployment rates rising. The government's looking for more and more things to tax. Lots of people unhappy about high rates of immigration, and the typical sort of whinging poms, I suppose you might say. There's a bit of that going on. So yeah, what else before we come on to our big three news stories of the week. I just had a sprint through the Cotality chart pack this morning, and for the housing market, extremely low listings. They're about 20% below what you would normally expect to see for this time of year. So if you're in the housing market at the moment and you can't find good quality stock to buy, well, you're not Robinson Crusoe there, because that's impacting almost everybody. And I suppose the other thing that Cotality reported, which I suppose mirrors what other providers have said, is that rents are now re-accelerating. We had a period there where maybe for a year or so it seemed that sort of the growth in rents was sort of steadying, and now suddenly we've got rental vacancy rates back near record lows. We've got 5 capital cities with rental vacancy rates below 1%. Melbourne is probably actually the only city where things have eased a little bit, but everywhere else looks like rents are picking up again, and the rent shock is back on the table. So that was the main sort of news from my end this week. Anything else that caught your eye?
Yeah, well, it's I would just say, yeah, that rent shock, I think we're going to talk about a bit more, but that was probably the big one. And I maybe this is a question for you about Melbourne v the other cities. I often hear Alan Collar talk about this a bit, is that because of the proportion of apartments in Melbourne, some of those figures might not give a true representation at the highest level. So I'm curious to pick your brains on that.
I think, yes, Melbourne, if you actually look at it, over the past 15 years in particular, I mean, I suppose Melbourne has been much more amenable to the construction of new apartments, high-rise apartments. I'll probably be staying in one of them, I guess, when I'm down in Melbourne in a couple of weeks, down at Docklands or somewhere like that. I mean, there's entire new areas of apartments that have sprung up in the previous cycle. And I suppose Melbourne also, just in terms of the number of detached houses, it spreads much more easily. So if you remember when we drove out to Wang a couple of years ago, Melbourne really, really spreads. You know, there's buildings going on for miles and miles out towards the bush. So the housing supply in Melbourne has generally come a bit more easily. Sydney seems to be a lot more constrained in terms of land prices, but it's also surrounded by water and national park. So it doesn't spread quite so easily. And it also, if you look at things like build to rent, again, Melbourne's going to be the epicenter of the build to rent sector for all the same reasons, I think. You know, the land prices are a bit more achievable to get the required returns, and development approvals seem to go through a bit more easily. So I've completely forgotten the original question. Market's distorted by the higher share of apartments? Yes, potentially a little bit. I think if you went back to pre-2015, Brisbane had a very, very low share of attached dwellings, and then suddenly we got a big boom in construction. But Melbourne, comparatively has a lot of apartments, and it's actually increased in recent years. And I think that will be an ongoing trend, actually, as the city expands. It's about, 5.5 million today, probably heading to 8. So that's going to require a lot more medium density and higher density dwellings.
Yeah. No, it's interesting because I often find that people that are looking to invest in Melbourne get a bit of a surprise. It's not like a shock, but it's a bit of a surprise when they go to look at standalone property like a house, and they're in one of those, maybe not inner ring, but one of the outer ring good suburbs. They get a bit surprised at the prices and the demand for those properties, but because I think a lot of them maybe just aren't digging deep enough, to be honest.
Well, yeah, I think, one of the things that has really been evident in Melbourne over the past 15 years is that most apartments have shown very, very little capital growth. And a lot of investors have been scared away by that. And so they're looking towards the sort of detached house market. And it's not cheap in the sort of landlocked suburbs where people want to be. So, yes, you can go out to the outer suburbs and find houses from, say, in the mid 600s and upwards. But if you're getting closer to the city, not necessarily quite so cheap. So let's run through the top 3 news stories of the week, and then we've got a couple of listener questions at the end, so stick around for those. So firstly, tax reform. So we've got the round table discussion coming up in, where are we? It's only a week away now at the time of recording. So the Treasurer is having a bit of a heads together with the ACTU and various other interest groups to talk about productivity and tax reform. I saw the ACTU is proposing a shift to a 4-day working week. So Australia must be the only country in the world where we have a talk about productivity, and one of the main proposals is just to work less. But as you say, no shortage of brainwaves in Australia at the moment. I guess just, there's always like bits and pieces that get leaked out before these events. It sounds like negative gearing is off the table. I think we've already got record low rental vacancy rates in a lot of parts of the country. And I just think if you start playing around with negative gearing at this stage in the cycle, there's just a risk of it slowing new housing supply, increasing rents. It just wouldn't probably, just from a political perspective, it would be a risk, I think, at this stage. I think, you could argue that as interest rates went up, more investors held on because they had the negative gearing benefits in their favour. I had a question for you. I know you've got a planning business and you've got advisors. There's been proposals about taxing superannuation, particularly balances over 3 million, with unrealised gains being taxed. Are you seeing any impact from that? Are people sort of having second thoughts about putting money into super and so on, or is it too early to say?
No, they are. Yeah, they are. And I think maybe more so folks similar to yourself, Pete, that have leveraged assets. That's probably the big unknown, because if you're taxing unrealised gains, what are you taxing? The gross value of a leveraged asset? That's pretty scary for people to think. And so, yeah, we are seeing that. And it's not so much the people retiring in the next 5 years, because obviously as you get closer to 65 or 60, there's more in your control. You can contribute less to super, you can contribute more, you can just keep it as it is, you can open a second super fund, and then you have one in pension phase, one in accumulation. But the problem is for people that are higher income earners, really aggressive saving, maybe say 30 to 45, what we're seeing is a lot of real conscious decision making around not using super as much anymore, which, to be frank, is what the government wants, because they want you to have a great super balance, but not too much, because they want to collect their pound of flesh, right? And so we saw a resurgence of family trusts, and we're seeing this still now, which is a bit of as you know, it's a bit of a joke for some people on social media and all that. But then the other one is investment bonds are coming back in a way. They've always been there. And then, the bucket company structures for business owners and for people that are consultants or that type of thing, just to hold up some assets for a while. You obviously need to be very careful if you're a consultant using a bucket company, just to be clear. But we're definitely seeing that, Pete, because people have recognised. I think I was chatting to one of your clients the other day. He was like, well, we all know that super is going to be not what it was. So I think that inflection in the kind of perception of what super is the big one.
I think that's the one of the things that people have flagged with me is like, well, okay, we're starting with this discussion now, but what if that balance is not indexed? And also just question marks around, well, if I've got an asset like, if a doctor has got a business with a medical centre in their super, how is that going to be taxed? They're going to be valued. I suppose you could certainly argue that assets would be valued in a self-managed super fund, for example, every year anyway. But taxing the unrealised gains, it's messy, potentially. And if anyone's got money in a startup or that kind of a fund, well, gosh, yeah, that's very messy, potentially. And not really following the tax principles very closely in a lot of ways. But anyway, we'll see. I was just wondering because, I figured that one outcome of that might be people stop being quite so keen on pumping up their super balance and start looking to do investing back in their own name or outside of superannuation. And there could be some sort of second order impacts on the housing market via that way.
Yeah, we know that there's capital gains tax discounts, which we'll probably talk about. There's negative gearing. There's debt recycling, which is a tax shield as well, a very good one. You can then delay or distribute income through family trusts and unit trusts. You can use a company structure for certain types of property investments. They're investing in the spouse's name. There's so many different things you can do. I think it's just a bit of good old-fashioned just roll up your sleeve and build assets everywhere. Like, at the end of the day, super is just one of the tax structures that we have available. It's the mandatory one, but we all have the other tax structures available. obviously get independent advice on this, because most professionals love to set up a self-managed super fund. Don't get me started. So we close more than we would open, I would say. But just get advice, because if you've got a 10, 20, 30-year runway, which I know a lot of the people that you speak to, Pete, do, you're not investing for now, you're investing for then. What would future you want you to have done? And I think people get scared off by a $4,000 trust bill or something like that to set one up or whatever. But, I've had a family trust for many years and it hasn't paid any distributions because it's all bottled up into companies. But that's probably going to pay off in 10 years, right? So I'm fine with that. So just think long term is what you advocate for every week.
Yeah, very true. Well, it's only like a week away or so we'll start to see what comes out. Treasurer Chalmers had promised a once-in-a-generation tax reform, but we'll have to wait and see. We've already got very high top rates of income tax in Australia, so potentially some reforms in other parts of the economy. So let's see what happens. All right, second story of the week, which we already touched on actually, rental shock return. So SQM Research, Cotality, practically everybody was reporting that it looked like inflation in rents had gone away, but suddenly now rental vacancies are tightening again. Looks like rents are re-accelerating potentially. I think just from an inflation perspective, I mean, obviously what SQM is measuring is asking rents, whereas the ABS reports on a sample of actual rents in the housing market. So it operates with a very big lag. And I don't think it will have any impacts on rental CPI or inflation anytime just soon. But it just for people actually active in the market right now, and if you're looking for a rental, well, you may find that it's quite competitive. I think 5 capital cities now have got extremely tight rental vacancy rates, and Darwin's tightening, and Brisbane's well under 1%, and you've got sort of Adelaide and Perth have already been extremely tight. So yeah, I think it's a difficult time. I mean, I suppose for younger people starting out in the rental market, it's not much fun. It doesn't make it easy to save and start your investing. As they always say, it's that first 100K that's the hardest. And if you're being slugged with high rents, that's not going to help. I suppose what more people are doing is staying home for longer. They're in many cases buddying up, and we can see that in the average household size is starting to increase again. So there's a long period where that was falling, but it seems like things are maybe picking up again in that regard. What sort of advice do you give to younger people? Because it's not much fun out there in the rental market at the moment.
Yeah, it is not fun. I think that's probably the first thing to say. We actually have a lot of people that provide for others in their life as well. We have, I speak to a lot of people that they pay for the rent for their mum, or, these types of things, or they help out their family. And if you think about that, like it's very, very expensive. No matter what, it's not just young people, it's all types of people, Pete. And I think for young people, some of the levers you can pull, I wrote about this on the weekend email actually, is how do you break to that 100K? Like it's like a magical number, I would say. The fastest way to get to 100K is to save more money. And it's not to invest better. It's not to pick a good stock or crypto or some crap. It's actually just to save money. And there's only 2 ways you can do that. You can cut your expenses, which is almost impossible with rents going up, or you can earn more. And one thing I've always found really kind of motivational from hearing your story, Pete, and you've talked about it a lot on the show, is you had a good income when you were younger, but you were spending a bit of money. But what you did next was just, you got obviously frugal, but you also got really creative, the two of you, with how you manage your money. And I think that's probably the secret that a lot of young Aussies need to think about is, how can I get creative with earning more money? Whether that's in your career, a side hustle, extra shifts or something like this. It's not forever. It's just for a few years, because you kind of need to break the ceiling on what your living expenses are. So when you have that second job, you don't then go and spend more. That marginal amount of income is actually far more valuable to you, because more of it drops to your savings line because it's incremental to what you're already doing. And I did this when I was younger. I had 2 jobs most of my 20s, to be honest. Worked a contractor role at the Motley Fool, worked in a, PAYG job, all that sort of stuff. And I think that's probably the secret. The other thing from a property perspective, definitely, is utilize the First Home Super Saver scheme. It's got easy to use, 50 grand per individual. You can't put that in 1 year, but there are a lot of T's and C's, but it's definitely one that's a good one because I don't know how familiar you are, Pete, but with the First Home Super Saver scheme, the rate of return that you get inside your super when you put that money in is not the return of the super fund, it's a deemed rate. And that deemed rate is based on the ATO's shortfall interest charge, which sounds like a lot of gobbledygook. It's effectively 7% per year at the moment. So where else can you get 7% per year for your savings? There are a lot of T's and C's. Obviously, get in touch with your financial advisor, but where else can you get 7% savings without taking all the risk of investing in something speculative? I think that's a real good one for people to explore with their advisor.
I think one of my sort of not so popular or less popular opinions is that I think sometimes people spend way too much time trying to get like the perfect investment plan together, but not enough time thinking, how can I get radical? You know, you mentioned the good word there, hustle. That seems to sometimes goes out of the discussion. You know, people just assume there's one way to do everything. But, you know, there's lots of things you can do. You can move in with your parents for a year. I know it doesn't sound like fun. In some cases, it might not be. Or you could work overseas in a country with a low tax rate. You could, or where you might be earning a good money with a per diem. Or you could, as you said, you could work a second job. You could start an internet business. There's so many things you could do if you really want to make stuff happen. I think, you know, you'd see a lot of these articles. There's one in the Times in the UK today about people graduating and from Oxford and Cambridge University and not finding jobs. But then when you kind of read the article, you know, people have just basically graduated. They've sent off 100 emails to like just loads of people, scattergun approach across multiple, you know, maybe 8 different industries, and you know nobody's replied. Oh, it's really hard. It's like, well, yeah, if you if you take that kind of approach, it is going to be hard. It's a competitive world out there. And as you said, yeah, in our case, I was a spender, and then I thought, right, how am I going to change this? And you know, you got to think of ways to get radical, and that will have a much greater impact than whether you get 8.7% per annum or 8.6% on your investments. So let's look at the third story of the week, which is not actually a news story. It was more of a question I had for you. I was interested to know what your thoughts are, the outlook for 2026. I think it might be interesting to talk about what you're doing, what I'm planning to do. I'll start. We currently have just started doing a renovation, actually, in the UK. So what I'm finding straight away, we actually bought a house in the UK because we're spending a lot of time over here with parents getting old, and we're just doing a reno. The budget, I haven't got it in front of me, but in Aussie dollars, the reno budget's about 320 or 330, something like that. But every line item so far has gone spiraling over. So I guess my point being, if anyone's thinking of doing a renovation at the moment, probably safe to assume it will cost more than you think, and it'll probably take longer than you think as well. Yes, you already mentioned I've got some funds that have landed in my SMSF, so I'm just thinking about whether to do a residential property in there. I previously had one, I sold it, so I'm just thinking about that, and maybe Melbourne could come into the equation. The other thing I'm thinking of doing is just allowing my kids to do a bit more stock picking. So they're very interested in that. You know, it might not be huge numbers from our perspective, but just from a learning perspective, I'm really keen to sort of teach our kids entrepreneurial skills, because I think they could prove to be sort of important in the future, maybe even more so than your academic qualifications. So, yeah, what about yourself? What are you seeing on the horizon? Are you're not tempted to go harder into the real estate world? You're sticking with the ETFs and stocks and shares?
Well, before I get to your question, I actually did find a property for you, Pete. So here in Melbourne, for anyone that's watching, you'll be able to see this. I'll walk you through it if you're listening. It's 62 Clendon Road in Toorak, Victoria, Pete. It's been on the market for a while. It's gone a little bit stale. There's some good like planning and overlays here. Good, just kind of yardage on a hectare. The only problem is you'll just need about indicative pricing about 105 million in your super fund. So I think you're pretty good for it. So I think that's the one, Pete. And I'll just take a nice little commission on that one. Thank you very much.
As someone who spends a good deal of my professional career working in Southeast Asia, London, and numerous other places around the joint, I don't have very much money in my super, and it's certainly not anywhere close to 105 million. So, yeah, but you got to think about those unrealized gains as well, if there are any.
Imagine that.
Yeah.
No, so for me, I would, to be honest, we're actively talking about property because we're still in our first home. We just had a young one; he's 5 months old now, and so we're very blessed, Pete, in that we've now got, in effect, 3.5 businesses. They're very stressful, hence my hair loss. But I think like over the past year, one of those businesses has started to hit an inflection point, which has been great. The other second business, which is a big part of my focus now, still needs a bit of capital. So effectively, just off the top of my head, I think we would have to have 7 or 8 different entities, tax entities, and I don't have a self-managed super fund. So a lot of my capital has just gone back into the businesses over the last 3 years. And it probably will for another 6 months or so, because there's a cash flow drain, obviously, in a lot of early stage businesses, as you can appreciate. So that's been part of my focus. In terms of, like, we've obviously, my wife and I, we have investments in our own investment service. So we run one. I don't want to promote it too much, but we have an investment platform, and we invest in the model portfolios as well. And what I can tell you, because it's all public, it's on the website, but we have a lot of obviously US shares in there, which we've been very grateful for. We've got some gold in there now, which has been really good. We've got the Charter Hall Long Whale REIT, which trades under the ASX ticker symbol CLW. So Charter Hall Long Whale REIT, Charter Hall, obviously a big property manager. It's got a lot of mixed assets in there across the commercial spectrum. So office, it's got like service stations, for example. It's got warehouse, it's got all that sort of stuff. And the key point is that it's got a long WALE, weighted average lease expiry, so it pays a good income. Not here to give stock tips, but that's something that we added recently, just as rates are coming down. It's a bit of a bit further up on the risk curve for us, but that's there. The other big one is, Pete, and you alluded to it earlier on, which is that what are people going to do if interest rates start to come down? We just had the Treasury Secretary in the United States come out and say that US interest rates should be 1.5% lower. I think he's a bit of a loose cannon. So, but like you hear these things and you think to yourself, well, what's my term deposit going to do? What's my savings going to do? All of those things. So we've got a lot of bonds in our portfolios, which we'll have to find a home for. We can't keep them there forever if interest rates go to the bottom, and then what do we do next? So that's been on my mind. But at the moment, Pete, just to summarize my rant, it's reinvest in the businesses for probably the next 6 months as much as possible. Then we're going to look at potentially how can we get our borrowing power back. Obviously, bring back some of the loans that we've made to our businesses, but bring back that, and then we're going to look to upgrade. We would love to upgrade down into the Mornington Peninsula with a few acres, which is incredibly expensive here in Victoria, or maybe even go slightly further out to the edge of the Yarra Valley. So that would be our dream, but we'll see.
Beautiful. Yeah, fantastic. It's interesting you mentioned about the US there, because, I mean, whatever I say today on this recording will probably be out of date by tomorrow, but obviously they're talking about deep interest rate cuts in the US, and so far, bond yields have actually played ball and come down. Whether or not that continues is a whole other question. At the time of speaking, Australia's September RBA meeting is that there's a 40% chance of a cut priced in, but I'm actually speaking with you just now before the release of the labour force figures. So if we get a strong jobs report, that will melt away to not very much. But anyway, yeah, some interesting stuff going on there in the US. Probably not best practice in terms of central bank independence, but anyway, so we've probably got time just to wrap up with 2 listener questions, and I'll let you get back to running all those different businesses you've got under your banner. So first question from No Names. Bought my first property 1 year ago. I've just started investing in ETFs. Should I focus more on paying down my mortgage first or investing in ETFs more? I've also heard you speak about debt recycling, but I don't know how that works or if I'm even in a position for that to be a benefit to me. Yeah, I mean, this is why when it comes to sort of building a financial plan, it's not just as straightforward as, well, you buy your first house, you pay down the mortgage, because then people start to want to invest in other assets. And I'm not sure if this is an investment property or a home loan. I think if it's a home loan, you generally have that on principal and interest because it's not tax deductible. But my personal view is the inflation generally is quite kind, and it sort of inflates away the value of a mortgage. So I'm never in a great rush to sort of accelerate repayments. Personally, I'd be more keen to see people start investing, not just purely from an investment perspective, but it's also a learning exercise. I think just sort of getting a feel for how ETFs work and the market cycles and the process of investing, you'll learn so much by doing that. I think it's very easy to sort of paper trade or invest with small balances, but as you grow your sort of ETF balances, it becomes a bigger piece of the pie, and you learn a lot of lessons about the psychology of investing. So look, if it was me, I'd still have the mortgage on principal and interest, but I would probably look to invest as well rather than accelerating the mortgage repayments. What about you?
Yeah. I mean, there's two things here. I guess there's what I agree with basically everything said. I think there's a few things here. One is there's a difference between a spreadsheet and your lifestyle and your behavior, so to speak. So a lot of, for basically everyone, Pete, debt recycling makes sense. I'll explain what that is in just a sec. But the problem with that is not everyone understands it. And a lot of people are stuck in a very pragmatic, I dare say, old school mentality of paying down your home loan. And that gives you satisfaction, the sleep at night factor. Chris talks about this all the time. If you use your mortgage effectively, you redraw to a certain limit that you're comfortable with, you've done your cash flow analysis, you've done all that sort of stuff, you can invest, and we see this with, you do talk about this too, is you can redraw some equity and use that to invest, whether it's another property or whether it may be shares and ETFs. So many ways to do that, and there's so many tax benefits to it too. So just for people that may not be fully understanding what debt recycling is, just imagine you have $1 million property and you've got a $500,000 loan. Most banks would lend you up to 80%. So there's an extra $300,000 of equity. You refinance, that goes into a separate loan account within your online bank. And there'll be a few $100,000 in there, and then it'll be matched by another a cash account that offsets that. And you take that money and you can invest it in basically whatever you want. Very popular strategy. The difference between debt recycling and equity release, just real quick. Debt recycling means you only ever borrow up to a certain limit. So you recycle the amount up to a limit. Equity release, which is what I do, Pete, is you just take as much as the bank will give you. And every time your property goes up, you refinance and you just get more debt. And I don't advocate that for everyone. I think debt recycling is a great strategy, and you can do it, in $20,000 increments, $50,000 increments. Most brokers like Chris and that team at Alcove would love for you to do a bit more, so it's not as much admin, and I would suggest that too. But really good strategy. You can use shares and property together. Obviously, everything we say here today is general in nature, as the disclaimer reads, but go and explore that idea of debt recycling. Go and explore all your options you have available. Because as Pete said, you can hustle and then you can get creative.
Fantastic. Thank you. One more and then we'll wrap up. So second question from Penny Panther. There are a lot of happily single women, often mums who divorced in their late 40s, early 50s. We're planning on retiring single and have good but not amazing incomes. Here's the question. How do we balance saving for retirement, paying down the mortgage, having an emergency fund, which is super important given there's no one else to rely on if you lose your job, and simply enjoying the here and now? And also, how do you know when to seek financial advice, given that this will hit the emergency fund? By the way, my emergency fund is split between mortgage offset and in ETFs. When I spoke to Gemma on the Australian Finance podcast a few weeks ago, she talked about the concept of the singles tax, which is a sort of an elegant way of putting what I was actually talking about. And that is that it's actually harder sometimes for a single person because you've got the one income, but then you just find, well, particularly if you're single, certainly in my experience, you don't really want to sort of spend as much time at home necessarily. You want to be out there socializing, meeting people potentially, and that itself cost money. I mean, I think in terms of enjoying the here and now, I think the best thing you can do is really find like-minded friends who are keen to have cost-friendly fun. I suppose if you're hanging out with people who like flexing or outward displays of wealth, I mean, it's very, very difficult then. So because you do need to be mindful of all those things. What sort of advice do you give, I suppose, in terms of balancing up retirement and paying down the mortgage and the emergency fund? I suppose in some respects it's a similar question to the first one, but it's a little bit different given the specific circumstances that Penny mentioned.
Yeah. So you talked about Gemma's idea before. Chris has the same one, but in reverse. Chris says that the financial world is built for couples. I was going to have a joke with you earlier on that I got some advice from a young person that lived in Sydney not too long ago. She said the way to increase your borrowing power is just to be in a throuple. And maybe that's the future, is just to have, 3 people under the one roof. But so I think that we deal with a lot of people in this regard because divorce and setbacks are a reality of life. Not just divorce, it could be death in the family, it could be so many different things, and everyone's circumstances are different, so it will vary. But just generally, I mean, I think it all starts with getting a good handle on your income. And once you have a handle on your income and your expenses, you can then figure out what's my surplus or deficit every month, and you can make more informed decisions. And so from there, obviously, if you've got a good income, you're going to get super contributions anyway. So simple step is just check your super fund, make sure their fees are low, and you're in a growth option. Go the highest growth. This is not personal advice, general advice only, but go the highest growth. Most people that have smaller super balances don't have the big behavioral bias of a large super bouncing all over the place. And also, you've got a long time, 60, 65. So that would probably be the first thing, Pete. And then I would just say, there's a big cause for investing in future you, but if super and property is what you have at retirement, that's amazing. A lot of people don't have a property when they hit retirement age, and a lot of people don't have a good super balance. To have both of those, or even a modest one of each, is fantastic. So chances are, no idea who this person is, but Penny Panther, sounds like you might be on a good trajectory regardless. So build that savings buffer, stay in the moment as much as you can, but also just that one eye on the future would be great too. I know that's not a great answer, but it sounds like they're doing a pretty good thing. As for the final thing, just financial advice, cost of financial advice varies in Australia. Everything from, say, $4,000 or $5,000 up to, how long's a piece of string. You don't always need to see a financial advisor. Even though we offer financial planning, I'm here to say you don't need to see a financial every time. You can see a mortgage broker because they take their money, their fee out of the mortgage. You can listen to the podcast. You can go and see a money coach. You can surround yourself with great friends who know things. You can join a group. There's so many wonderful things where you can get like that 80-20 rule, Pete. You can get like 80% of the way there with 20% of the cost probably. But I think that you can also get once-off financial advice. And some firms do this. We don't do this as much, but you can sometimes pay for your financial advice from your super. Just be careful. You don't want to deplete that too much. That's my rant.
Perfect. Fabulous. Thank you. I mean, some handy advice there. And you may be able to hear in the background, I don't know if you can pick it up, but it's got a furious storm that's just about to... Yeah, so hopefully. So far, it doesn't seem to have actually rained at all, but the garden certainly needs it. So probably a good time to wrap up. What's on this weekend for you?
Not much, mate. Just we've been in and out of ED this week with our little one, so he's all right, but it's just been a hectic bloody week. So hopefully just a bit of taking it easy and maybe watch a bit of Clarkson's Farm or something like that. Don't mind that. Might see you on it in a couple of years, maybe. But that's it for me. What about yourself?
Well, good luck with everything at home. I'll be going down to I've got a day at Trent Bridge at the cricket, so going up into the executive box for that. So that'll be good, and then down to the Cotswolds for a week. So I'll try and get my head onto the Clarkson's Farm. I actually bumped into old mate Caleb down there a couple of years ago. I got a selfie with him, which was a nice little snare. But you see, it's a beautiful part of the country down there. It's England at its absolute best in summer, so that'll be good. And only a couple of weeks away, and I'll see you around the traps in Melbourne. We'll have to check out a few of the Mexican joints
Yes,
when I'm
we
in
will
town.
indeed. Brilliant, mate. Thanks for having me on.
Cool. Thanks, everyone. Send in your questions for next week. And don't forget, join us at the Rask Community Forum. That's community.rask.com.au. Drop in your comments, questions, and whatever else you want to put in there. It's a really good resource and all free, of course. And look forward to seeing you next time around. Thanks, Owen.
Cheers. Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.